This is InvestTalk. Independent thinking, shared success.
Hi, my name is Nima Saram. I'm a student at Purdue University. I wanted to get your take on a few different tickers, NNE, Oklo, and SMR. They're all nuclear energy companies, and I wanted to see what your guys' thoughts are as they've been moving recently. Thank you.
So let's quickly look at these three tickers, then we'll kind of talk about the industry more broadly, and then we'll probably answer this question a little bit better. So NNE, Nano Nuclear Energy, as you can see, very small company in terms of market cap, only about $1 billion in market cap. Doesn't make a lot of money. Very similar to this next company, Oklo, in that what they're trying to do is develop small modular nuclear reactors. Okay. And because they're in the development stage, well, not a lot of revenue, in this case, no revenue, even into 2025. And as you just saw with NNE, no profits. So these two first names are emerging technologies and frankly, in the same space, right? Microreactor innovation, modular nuclear reactors. And so one could argue that probably one is going to eat into the other's gains in the market, eat at their market share, should one of these two be successful. And as you know, if you listen to the show, we are value investors. We like companies that have sustainable profits, that have solid growth, that are built on good fundamentals. And both of these two companies, the first, NNE and OKLO, are based upon future potential growth. There is no income to these companies today. And so of the three, we then have to take seriously FLR. And FLR is a Fluor Corporation. And what they are instead is a leader in engineering, procurement, and construction services that services the nuclear sector. And they do it in a pretty diversified way. Most of their revenue does come from North America, about 68%, but they still get 15% revenue from Europe. It is, as I mentioned, a more established company, about $9 billion market cap. And it has grown in the past 52 weeks by 26.51%. It has a pretty solid record of performance going back to 2021. And up until recently, its sales had started falling, had headed in the wrong direction. Right? They had $14.3 billion in revenue in 2019. And it wasn't until 2023 that they started exceeding that, $15.4 billion in revenue, projected to grow and grow and grow headed into the next couple years. And they do have income. They haven't lost money since the pandemic. Their margins have been expanding from 1.1%, projected to be 2.5% this year, or rather last fiscal year. They are reporting on the 18th of February, and grow again to 2.7% next year. And it's relatively inexpensive, 16 times forward-looking earnings, 0.5 times price to sales. Book value, price to book value, 3.6. And so when you have to choose between these three companies, I think if you come from a value framework where you are investing in established companies that have grown or are growing, whose margins are improving, whose cash flow is improving like this company's is, who have very little debt, only $1.1 billion in debt on the $8 billion market cap company. I think if you have to choose between these three, our obvious choice goes to FLR. FLR. Thanks for the call. Looks like we got our first live call. James from New York has a question about Qualcomm. Do you own it or are you looking to buy it?
I own it. I've owned it for a while, and I noticed it had a really positive earnings report after hours today. And yet the share price is down 5%. I was wondering, what impact, why would that be a result in reaction to such a positive earnings beat?
Well, when we talk about earnings, generally you can't put too much credence in what an earnings beat is because the market doesn't really care that much about earnings estimates and how well you did in the previous quarter. I mean, they do, but generally speaking, it's more focused on forward-looking guidance. Now, in this case, the company honestly issued some pretty upbeat forward-looking guidance. And so you might be asking yourself, well, what then is driving this price downward? I don't put too much credence into aftermarket moves. I think the most important thing to do is see if it follows through tomorrow. The reason why? Well, there's two reasons. One, it's usually very low volume, meaning that any trade can move the price up or down by a significant margin, right? The spreads are also a lot wider. Another reason is because the people who trade after aren't necessarily the smartest traders, but they're the most high conviction traders. And so we don't know exactly why any stock moves as much as it does up or down in after hours trading. You're going to see higher volume related to earnings, but still it's pretty low volume trading. So I think generally speaking, right, what is going to drive this forward is going to be more related to some of the trade tensions with China, some of the national security related restrictions on selling to various countries. But overall, from what I saw, and I haven't had an opportunity to dive deep into the earnings report for Qualcomm, not only did they beat consensus, but the guidance was pretty solid looking forward. And so I would wait to see what happens with the follow through tomorrow. I don't think there's any reason to panic. Just keep in mind, always take after hours trading with a grain of salt. Remember what happened in U.S. Mexico, or when it was announced that there were 25% tariffs on U.S. or on Canada and Mexico. Futures opened up way down. But what happened the next day in the market? Well, even before the announcement that Mexico had done enough in Trump's eyes to prevent those tariffs, market was only down like 90 basis points, or 1.2% at that point before it clawed back to 70 basis points. So I wouldn't put too much credence, like I said, in after hours trading. Let's see what happens tomorrow. Thanks for the call. Let's dive right into our InvestTalk YouTube question bank. I hope by now you've gone and checked out our YouTube videos. Originally, way back when we first started it, we were posting the podcast, but in video form. Now, we pick and choose what we post. We have a market wrap-up segment, we have a caller question segment, and we have a focus point segment. You can go in, watch it what you want to see the charts we show for the questions. I like it. I think you'll like it. You should go check it out. And while you're over there, if you have a question, feel free to leave it in the comments section of one of our videos. This one on tariffs in China. And it says, how are tariffs on China going to affect Vietnam? My thesis is that they would benefit Vietnam, but I'm reading that some analysts think it could actually negatively affect Vietnam's rapidly growing GDP due to trade policies becoming more strict with the current administration. I own VNM and was thinking about adding to my position. So this is an interesting one. And I think it shows essentially the effect of tariffs and how it can benefit certain countries. If you are having a targeted tariff on China, be it for national security reasons or other reasons, people who use the supplies, whose supply chains run through China, are more likely to move it to another country like Vietnam or like India, where it is slightly more expensive. Perhaps the manufacturing quality is slightly lower, but still far less expensive than moving it back to the US. And so if this trade war continues, if it develops, if it worsens, certainly I think that countries like Vietnam will probably stand to benefit a little bit. Now, it could be the case, given that the president is also threatening tariffs on Europe, that in turn he could threaten tariffs on Vietnam, because I think the general thesis here seems to be he has a fundamental belief that trade deficits are bad. And so if you start importing a lot more from Vietnam than you're exporting to Vietnam, that increases your trade deficit. Well, then maybe tariffs will be slapped on Vietnam, but that would be a down the road thing. I think the immediate benefit, before anybody starts reshoring manufacturing or industry supply chains back to the United States, is to pick these companies, or rather these countries, like Vietnam, like Mexico, like South American countries, like India, where we don't have historic competitive battles in the national security realm, in the military realm, in the manufacturing realm. I think a lot of these countries could stand to benefit should the tariffs become worse. Thanks for watching. Looks like we have another live call. Kumar from Fremont asking about UTRX. Do you own it, or are you looking to buy it?
No, it's not UTR, Tonics. TONIX, Tonics. TNXP.
TNXP, Tonix Pharmaceuticals. We got it. Thanks for sticking with me there, Kumar. So do you own it or are you looking to buy it?
Buy it.
Looking to buy it. Okay. Well, let's take a look at Tonix Pharmaceuticals Holding Corp. So Tonix is a clinical stage biopharma company. They focus on discovery, acquisition, and development of small molecule and biologics to treat and prevent human disease. So this company is a fairly small company. Or no, it's actually a decent sized company, about $8.5 billion market cap. And if you're looking at my screen right here, you're seeing a whole lot of red. And that is because they not only have had their price fall off a massive cliff, they're down 98.55% over the past 52 weeks. Their EBITDA is increasingly negative. Their net income is increasingly negative. They do not make any money at all whatsoever. They have very little debt, but you know what? Their market cap's only, $85 million. That's how small it is. It's an $85 million market cap. And so, keeping all of that in mind, I can easily tell you that given that this company makes no money, given that it doesn't pay a dividend, given that its cash flow is falling, its profitability is falling, it's becoming more and more negative, I would run and hide from Tonix Pharmaceuticals TNXP. Thanks for the call. Let's keep things going and tackle another caller question that came in earlier on 888-99-CHART.
Hey guys, this is Darren in Charlotte. I've got a quick question for you. I yesterday sold half my position in Palantir. I've got some passions on, and I'm looking at Celanese Corporation. Ticket symbol CE. Took a dive late September, and be a good opportunity to get in right now. I was just curious what your thoughts are. Appreciate it. Thanks. Bye.
Celanese Corporation, that is ticker CE, is a global chemical and specialty materials company. It's headquartered in Texas, and they are the leading producer of acetic acid and vinyl acetate. And their operations span a lot of continents, right? North America, Europe, and Asia. Now, in terms of their revenue breakdown, it is pretty even. 26% the United States, 23% Germany, 18% China, and the rest a mix of these other countries. It is a fairly, large company, $7.8 billion market cap, so a mid-cap name. Pays a 3.92% dividend yield and has about 6.07% short interest out there. Now, looking at their cash flow, it's fallen in the past couple of years. It's certainly on a downtrend. Their profitability is on a downtrend. And as I mentioned, they're a $7.8 billion market cap company, but they have $13.3 billion in debt. Their growth has kind of stalled a little bit. They had $10.9 billion in revenue in 2023. It's projected to fall over the next 2 years. And their margins are falling as well. And because of this, it doesn't really matter to me that it is trading at a cheap valuation. Sometimes things trade at cheap valuations for reasons. And this reason is because it has missed on its third quarter 2024 financial results. It's going to report again in February 2018. But not only did it missed because of market demand weakness that has now shifted their business to make production adjustments in order to cut costs because they don't see demand having picked up or picking up anytime soon. And so with their forward-looking guidance, they had profit downward revisions as well as reducing that dividend. This is not signs of a company that is going to benefit from some macro tailwinds in the future. And so because of that, especially with earnings coming up where it may be disappointing again, you could see this company fall off even more, even though it's down 51% in the past 52 weeks. For Celanese Corp CE, gonna have to pass. Thanks for the call. Now, we already talked a little bit about the de minimis exemption. And so as we know now, at least for another month, Canada and Mexico will not have tariffs put in place. But that's not the case with China. China had some pretty swift responses. They decided to go with a more aggressive approach. They announced countermeasures against American firms and trade barriers of their own. Beijing's retaliation includes an antitrust investigation into Google, the addition of biotech firm Illumina and fashion conglomerate PVH to its unreliable entities list, and tighter export controls on rare metals that U.S. companies need. Additionally, China will impose new tariffs of 15% on American coal and liquefied natural gas, along with 10% duties on crude oil, farm machinery, and large engine vehicles. While these measures may not significantly disrupt trade, Google largely exited China in 2010, and the country has also reduced its reliance on U.S. oil. They more serve as a symbolic warning of, if you escalate, we are not afraid, we will escalate. And this is all in the shadow of a Biden-era trade review, which is set for April 1st, which could reignite longstanding disputes over unfulfilled trade commitments and stealing of intellectual property. With many of Trump's advisors holding even more hawkish views on China, the risk of higher tariffs looms pretty large. China's strategy appears aimed at containing the conflict rather than escalating it. But Trump, known for his, let's say, symbolic gestures, may view Beijing's defiance as provocation in and of itself and escalate even further. His executive order imposing the initial 10% tariffs explicitly stated that they may increase or expand in scope if China does not back down. Now, while China can match somewhat the U.S. economic strength because of how important it is within the supply chain, it cannot match Trump's unpredictability. Rather than countering Trump's tariffs with direct retaliation, China's best hope may be economic damage inflicted on American consumers and businesses. The Peterson Institute for International Economics estimates that Trump's new tariffs will cost the U.S. economy over $100 billion between 2025 and 2040, even without Chinese countermeasures. Unlike his first term, where Trump's team was pretty careful to avoid taxing consumer goods, these new levies apply broadly. They include small parcels with that de minimis exemption and everything across the board. Now, there's also indications, based on his words, that he wants to extend this trade war to Europe. And so consumer dissatisfaction could deepen even more. He's already threatened heavy tariffs on the EU, which he claims has atrocious trade with the United States. And so this is going to be interesting to see. It's going to be interesting to see the effect it has on markets, the effect it has on the economy, because typically, if you're going to fight a big opponent, you pick a singular target. But based on what he's saying, it appears Trump is ready to challenge two economic giants at once. Now, we got plenty of time, so let's fit in this question from our friend Iraq Dawn, 1964, and it is on ticker ALAR. And it says, what are your thoughts on the small Israeli software company, ALAR, Alarum Technologies? It is expected to turn a profit this year, and some of its other ratios look pretty good. So let's dive right on into ALAR. ALAR is a $82 million market cap company. It actually might be in Israeli shekels. Let's see. Yeah, it's a $68 million US dollar market cap company. It's got about $2 million in debt, and they do issue a bunch of shares, right? But they did, it looks like, first start trading in 2017, and since then they've issued about 5 times the amount of shares that they started with. Now, they are getting closer and closer to turning a profit, right? They had negative 395% net margin in 2019. Last year in 2023, they had negative 21% net margin. And in 2024, their net margin is estimated to have been 22.3%. In the past 52 weeks, they're down 25.46%. Year to date, they're down 4.52%. And from a relative valuation basis, it's okay. I wouldn't say it's cheap, but it's certainly not expensive. They're trading about 2.2 times price to sales. Again, not cheap, but not too expensive. 19.8 times forward-looking price to earnings, certainly cheaper than what their 5-year average has been. Now, this company, which is a provider of internet access and web data collection solutions, has business all throughout the globe. What it does, their software, is it enables customers to collect data anonymously from various public web sources, utilizing proxy networks and software that ensures stability of data flow. And so for governments, this seems like it would be a pretty good tool. For businesses, advertising businesses, it seems like it would be a pretty good tool. And not only are they building and growing in terms of their revenue, right? Look at this revenue growth right here. It's pretty solid growth rate, 78% on an annualized basis. They're getting into more diverse markets as well. And so if you want to invest in this name, given that it may finally start making money, it looks like in March, it had a positive quarter. Looks like in September, it had a positive quarter. So it may in fact be starting to make money now. If it does make money, it certainly doesn't take on much debt, so it could continue to capitalize or continue to operate just based on its revenue alone, reinvesting in the business. They haven't really issued many shares since 2023, so I don't think they're a serial issue of shares. But still, as a long-term hold, with a long-term less risky hold, you'd want to see a longer-term cash flow trend. Now, they did have positive free cash flow in 2023. That's projected to improve as well. I think given that this company is starting to make money, finally having quarterly positive revenue, having this sales growth, I think if you wanted to have a small allocation to it, understanding that companies like this that are this small, that are pretty brand new, especially in terms of profitability, I think it's okay to have a tiny little allocation to this just because the use case of this software is so interesting to me. Governments, businesses, people, there's a lot of potential out there. Keep in mind, this is the type of company where you could lose it all. So as a long-term investment, for somebody who is putting this in their retirement account, I would say probably not. But if you're willing to take on the extreme risk of this name, I think it's an interesting one. Thanks for watching. Let's do 2 in a row from the InvestTalk voice bank, or rather the InvestTalk YouTube comment question bank. This one is on 3M. It says, what do you think about 3M? Is it becoming overvalued? Well, 3M's got a great ticker. It's MMM. It's one of my favorite tickers out there. And it's a globally diversified technology and manufacturing company. It has a wide array of products across various industries. Very large, $82 billion market cap. And in the past 52 weeks, it's up 96%. 96%. That is a lot of percentages. Oh, I'm sorry. I have been corrected. I am being berated by our producer who is telling me, you know what, Luke? This is not from YouTube. This is not from YouTube. This is from iTunes. This is somebody who is kind enough to leave us an iTunes review. And so I want to highlight that this question comes directly from our iTunes. But let's get back to it. Tom, I'm sorry. I hope you forgive me. Now, as I was talking about, 3M is a fairly large company, about $82 billion market cap. They've had a heck of a year, up 96% over the past 52 weeks. But sales are kind of falling off a little bit, right? They hit a peak in 2021, and they've started to fall downward. But net income looks pretty solid. They lost money in 2023, but their margins have expanded back up. 16.3% net margin in 2024, projected to be about 17.7% this year. Now, one of the reasons why they've benefited is because they have reduced costs, right? There's some pretty big cost-cutting measures which have made it a more efficient business and increased their bottom line. They also have a strategic partnership with a consortium of semiconductor suppliers. And so they've been creating this advanced semiconductor, or rather they've been manufacturing this advanced semiconductor technology for a wide array of research companies, for governments, and for private enterprises. And so that's why you started to see this turn for a company that has underperformed the market pretty consistently since 2019 to spin it positive this time around. And so the question is, well, is this company overvalued, right? That was the root of the question. Is this overvalued? Is it starting to become overvalued? I don't necessarily think so. It's trading at 3.4 times sales, 19.3 times forward-looking price to earnings. I mean, it's about the upper end of its 5-year range, so maybe it's starting to become overvalued. I certainly don't think it is a sell at this point. I think it's a hold at this point. They're pretty deep away from reporting earnings. I think that it's probably going to be more in tune with that secular AI growth driver that has been floating the market for quite some time. But again, if you look at this within the context of the past 5 years, yeah, it looks expensive, but they really have struggled the past 5 years up until this year. Thanks for leaving us a review.
Bill from Virginia here. I got a tax question. So say that I buy a stock, put $10,000 in it, and eventually it goes to $20,000. If I pull that initial investment of $10,000 out and sell, is that taxable, even though I'm pulling the original amount that I invested in and there's essentially no capital gains? Just a little confused in that aspect of things, and looking forward to hearing your answers. Thanks so much.
Stocks and taxes. I truly wish what you just said was the case, but unfortunately it is not. And that is because capital gains are measured at a lot level. What is a lot? Well, when you go out and you buy 200 shares of something, or rather you own 200 shares of something, maybe you bought 100 of them a week ago, you bought 100 of them today. The first 100 you bought at $98. That's one lot. One lot with a acquisition cost of $98. And the second one you bought at $100. That's the second lot. And so when you go to sell shares, your taxes due are based upon the difference between the sell price and the acquisition cost. So even though you put in $10,000 and now you put $10,000 back into your checking account, well, in your example, the stock doubled. And so you still sold half the shares. So what did you buy half the shares for? What did you sell them for? That's how you assess your capital gains that are due. Again, I wish it wasn't the case, but the tax man always wins. Thanks for the call. Now, we talked a lot about tariffs, but let's talk about Chinese demand. Because one of the things that's been missing from the global demand equation is really China. But China's Lunar New Year holiday saw record-breaking tourism revenue and travel numbers, providing a potential boost for policymakers working to revive sluggish domestic demand. Tourism revenue surged 7% year over year to 677 billion yuan, for reference, that's $94 billion. While the number of domestic trips rose 5.9% to 501 million yuan. The holiday also marked new highs in cultural and tourism market indicators, including record-breaking box office revenues of 9.51 billion yuan, with over 187 million people visiting cinemas. Cross-border travel increased as well, with 14.37 million trips in and out of China, a 6.3% rise from last year. Notably, trips made by foreign nationals surged 22.9%, reflecting eased restrictions on international travel. Consumer spending also showed strength, with goods consumption up 9.9% and services consumption rising 12.3% compared to previous years. Sales of home appliances and furniture were particularly strong. And these positive indicators come amid ongoing trade tensions between the U.S. and China. And so this is important because not only does the trade dispute add uncertainty to China's economic outlook, I've been saying for quite some time the reason why this time might be different is because the Chinese economy is not in as good a place as it was in 2018. It can't stand to challenge as much as it could back then because domestic demand has been so weak. One of the big secular drivers, or rather just one of the big drivers in general, of why oil prices didn't rebound as much as everyone thought they would is because Chinese demand has been so depressed. And so what this signals to us is perhaps an economy in recovery, perhaps an economy that can, certainly, given that they already are, standing up to U.S. tariffs, could complicate the picture. Looking ahead, all eyes are going to be on the Chinese People's Republic Congress in March, where policymakers are expected to maintain their economic growth target of around 5%. Measures such as increased government financing and monetary policy adjustments, including possible interest rate cuts and lower reserve requirements for banks, are likely, as Beijing aims to sustain economic stability while managing all those external pressures likely to come in 2025. Now, before we head off for the day, I want to remind you once again that at KPP Financial, We offer our clients not just investment advice, not just managing their assets, but we also build complete and total financial plans. So if you're interested, head over to investtalk.com and check out the free portfolio review. It is a free and confidential service. And you know what? We just love talking to you all. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And please be sure to leave us a rate and review. And you know what? If you leave us a question on iTunes, we will get to those as you've seen today. Independent thinking, shared success. This is InvestTalk.